The Sole Prop LLC LLP INC debate. Hello, my name is Arthur Jones,
Hi, I'm Nicole Jones.
and we're here representing the N. Jones Agency. And we're covering a topic that keeps coming up in business, and there seems to be a lot of confusion surrounding it. The topic is the debate between the formation of corporations in particular, the sole prop, the LLC, and the INC,
Right.
and which structure is the best for starting a new business. The best way to start this informational discussion is by explaining each type of organization and what its general restrictions and benefits are. So we'll start with the sole proprietor. The sole proprietor or sole prop is best described as you as the company. The sole prop is directly tied to your personal assets and your social security number. It provides the minimum civil and penal protections and carries a significant civil liability, as well as a tax liability under the owner's draw. It limits third-party funding opportunities because the funds are based on the proprietor's personal credit profile and banking information. There is no ability for capital investment in a sole proprietor. And there's also no significant corporate veil of protection. Would you like to expand on the tax ramifications of a sole proprietor?
Sure. For tax purposes, this entity serves as a pass-through, and all income and losses are added to the owner's personal tax return. This is done using a Schedule C, by adding a Schedule C to the owner's return. In addition to adding the Schedule C to add the income and the profit and losses, you also need to add a Schedule SC for self-employment taxes, because when you're on a W-2 job, the employer is responsible for paying these taxes. But as a sole proprietor, this becomes your responsibility as a business owner. Another thing is, as a sole proprietor, you are taxed on all income. Even if that money is left sitting in the account to pay for future business costs, it is still part of your income and thus taxable income. It doesn't have to be used. As he mentioned, you, the owner, you can't take a deduction for the portion of your income that you use to pay your salary, because this is what's called an owner's draw. And an owner's draw is not a tax deduction, but again, part of the company's profit and taxable.
Okay, we're going to move on to the single partner LLC. And the single partner LLC is a pass-through for tax liability purposes. And I'm going to cover some more of the corporate stuff, but when it comes to the finites of the taxes, I'm going to let Nikki handle all of that, because that's her field of play, so to speak. All right. The single partner LLC has limited protections for the personal assets of the proprietors, and it literally says so in the title: limited liability corporation. It doesn't say no liability. So it's only recognized by the state that LLC was formed in. And in order to do business in another state, you have to go through some more procedures and file more paperwork and pay more money. The IRS may actually choose not to recognize the LLC as a legal business entity. The LLC allows for very easy piercing of that corporate veil, which eliminates the protections for even forming the LLC in the first place. And let me explain how simple it is to pierce the corporate veil in the LLC. You start your LLC, and you file your registration paperwork with the state, and you pay for that with your personal credit card, veil pierced. You go to open your first banking account with that LLC with your EIN number, and you use your own funds to open that bank account, veil pierced. The LLC also restricts the funding opportunities. because the LLCs are commonly recognized as sole proprietors by the various funding agencies and third-party lenders. So they limit the amount of money that will be available to your company when you start. Now, there is also the multi-partner LLC or the LLP. They are also pass-throughs, which combine the personal income and the company income under what's called a Schedule C. And again, Nikki will expand on that some more before we move on to the next subset of companies. They provide limited civil protections which only apply with an intact corporate veil. They are only recognized by the state that they were formed in, just like the single-party LLC. And the LLP and the multi-party LLP, they only protect the partners from group liability. All individual liabilities are still included, and they are all passed through to the individual partners. And because it's a limited liability, they also allow for that easy piercing of the corporate veil. The restrictions on funding opportunities are still basically the same, although it expands the amount of personal credit profiles that are available to be viewed. So you may be able to get more money with an LLP. However, it's still going to be limited to the available credit and the banking practice and the banking procedures of the individual partners in that company. It only protects the individual partners from joint liability. Now, on the tax side, there are some unique things about the LLC and LLP, and I'm going to let Nikki expand on that for you some more too.
Right. As Sterling mentioned, the IRS for tax purposes may treat an LLC as a disregarded entity in the case of a single member LLC, because they view it for tax purposes, again, as a disregarded entity, and it is passed through to the owner's personal income tax return via Schedule C. However, a LLC or LLP, how it is taxed by the IRS will depend on the elections made by the company and the number of members, because in the case of an LLP or multi-member LLC, there are multiple members that have to be taxed accordingly. The forms that will be required for these elections will depend on the type of LLC you elect, how you elect to be taxed.
Agreed.
So the IRS will either treat your company as a corporation, a partnership, or it'll be part of the owner's return. So it won't be, it'll be part of that pass-through entity. So that all just depends on the elections you make.
Okay, we're going to move on to the INC, or the incorporation, and in particular the type C to start. The C-type corporation, it requires corporate operational procedures. They're regulated and they're watched a little more closely than the LLC or the LLP or the sole proprietor. And there are reasons that the government pays more attention to them, because in the C-type corporation, you sever the ties between your personal income and your corporate income, and in some cases completely, because you can option to W-2 and be an employee of the corporation in which you formed. This allows for separate taxation of that corporation and its owners. It also allows for the sale of private equity stocks to fund that corporation. It negates the personal liability for corporate activities. So if your corporation does something, say puts out a product that makes people sick, your personal assets won't be tied up in the resulting civil liability or civil lawsuits when the people sue your company. So they'll sue your company, and the insurance company for your corporation will pay, not you out of your pocket. The C-type corporation also allows for something called capital investment, which helps you to maintain your corporate veil. You are allowed to loan that company money to get that company started and not have that money tied to you personally. But that's something for a more advanced class, and there are some requirements according to the Securities and Exchange Commission that you have to meet in order to manage capital investment. Now I'm going to move on to the incorporation type S, because they're both under incorporation umbrella. So I'm going to move ahead and discuss what are some of the limitations for that. And the Inc. Type S or Incorporation Type S is very similar to the C-Type Corporation. However, there are some unique restrictions. The S-Type Corporation is limited in the number of shares that it is allowed to have available to sell. They're also limited in the type and the nationality of the shareholders. So yeah, anyone cannot buy your shares, you cannot sell your shares to anyone, and anyone cannot be on record as a partner in an S-type corporation. They must all meet particular approvals. Now, there are some tax ramifications that follow the C-type and the S-type corporation, and again, I'm going to let Nikki expand on those a little more, and hopefully you'll get more clarity on how the taxes apply to each one of those business entities.
Right. Now, for the C corporation, many people have heard of what's called double taxation associated to a C-type corporation. What that means is basically the corporation is taxed at the corporate level, and then the shareholders are taxed again at the personal level. Now, you may have also heard that there's no way to avoid this, but that is actually not true. But again, that is one of those more advanced topics, and in the effort to save time, we won't try and delve into that now. But just know that there are strategies that you can use to avoid double taxation. Now, for the S-type corporation, as it relates to taxes, there are the taxes are basically passed through to the shareholder on the shareholder's personal tax return. They're assessed at the individual rate instead of at the corporate rate. So that way it's not done at both. It's the income, the losses, deductions, and the credits. All of those things are passed through to the shareholders for federal tax purposes. This is one of the things that this is one of the reasons why people like S corporations, because they say that this is a way for them to avoid double taxation. But again, remember, I told you as a C corp, there are also things that strategies you can use to do this as well. Now, S corporations again are still responsible for certain taxes on built-in gains and for passive income at the entity level. As he stated, there are certain qualifications that you must meet in order to qualify for the S-type election.
Yes. You have to have approval from the Secretary of State.
All of the shareholders must be domestic.
Yes.
They must be what are called allowable shareholders.
Yes.
You can have no more than 100 shares, as he stated.
Yes.
Shareholders. There's only one class of stock that you can use, so you can't have multiples. The type of corporation that you have must also be an eligible corporation to qualify for the election. So every type company is not eligible. Some of them are excluded and in fact ineligible. But again, that's a more advanced topic.
Yes.
Now, as always, you should definitely seek legal counsel or the advice of someone who is well versed in these type subjects. You should also work with a tax professional of some sort or an accountant who specializes in taxes before you make your final election. That way you're doing what is best for you in your specific situation, because a decision like this is just like fingerprints. It is unique to you and what your goals and what your company's goals are.
And it varies based on the area, location,
state,
product.
Right.
Everything plays into it. What you do and where you do it can determine what type of corporation is going to benefit you or cost you the most.
Right. And for me on the tax side, the rules and regulations that I gave you are specific to federal taxes. So there may be some additional ramifications for your particular state, which is why you would, that's one of the things that makes it unique.
Yes. So if you need some further clarification on this information or some further business knowledge, please pick up a copy of Economic Clarity. It's the informational reference manual to the establishment, management, and extension of generational wealth. It is authored by myself and Nicole. Or you can contact us on Facebook and on IG at the N. Jones Agency. And as always, we thank you for increasing your economic knowledge with us today. I'm Arthur Jones
And I'm Nicole Jones.
for the N. Jones Agency Incorporated.